All right, welcome back, everybody. Today is February 11th, 2025. It's been a couple weeks since we've hopped on and did some talking. The markets obviously have been incredibly active, so I have been on the desk. But without further ado, let's kind of jump into it, go through the weekly outlook, and really talk about what's been going on over the last few weeks. So, little introduction. My name is Spencer Riegle. I am the Chief Crypto Options Trader and Strategist at DARMA Capital Trading. You can reach out to me at _RIEGLE, or I am on LinkedIn at Spencer Riegle. Quick disclosure before we dive into everything. All information and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk or loss if not, and is not suitable for all investors, right? And so what we like to talk about every week is only trade with risk capital, right? And what we define as risk capital is capital in which you're willing to lose all of it. Reason for that is on many different fronts. One is if you're willing to lose it all, it actually helps you detach from actually making money in the markets, and that's usually helpful from a psychological perspective. You're not forcing your will onto the market, and you're kind of letting the market come to you. But two is also there is risk in trading, right? And so it doesn't make sense to risk it all. It doesn't make sense to risk, let's say, your money for food, all these kind of things, right? And so it's always a focus on risk and reward, and we always focus on risk over reward to start, right? So let's kind of go through an agenda on and how we approach these kind of webinars, and we're doing a couple different webinars with a couple different teams, and so if you're unfamiliar with anything in which you're talking about, feel free to drop questions and ask as well. So how we like to go about this is macro events first, weekly price map update, so kind of our outlook on the markets for the week, and then we go through a small strategy portion to round off the session. And so let's start it off. We haven't been on in, I want to say it's been 3 weeks, and so there's a lot obviously that's happened. We got through the first month of the quarter and the first month of the year, which was Jan 31. We saw declines in markets, right? So ETH ended the month around 3,300. Bitcoin was slightly down, if not unchanged, and I believe we were at 102. And I'll pull that up here in a second. But the biggest thing, obviously, was the new Trump administration in the U.S. That was, which was seen to be very impactful on markets, and as we kind of got into February, we'll note how impactful that's been, right? And so Jan 20, new administration stepped in. The crypto industry largely as a whole, it's a bullish administration. It's fairly favorable in terms of macro sense, and yet the market's down, right? And why is the market down? Well, if you fast forward to today, the new administration we saw and knew was going to be fairly aggressive, and and to fulfill promises, that's exactly what the Trump administration did, right? And so they, out of the gate, they went into tariffs, right? And we went into a trade war, even though it was momentary, and that was between Mexico, Canada, the U.S., and that was resolved relatively quickly. And then also China. There was threats against the EU, just disruptive for markets across the board, right? And so this week, to start the week, there was tariffs on the aluminum and steel, and continually every week there's news headlines and bombshells that are dropped that are disruptive to markets, right? And so what does that mean for how we approach markets? Well, there's a couple different things. One is if we know that risk to be apparent, right, and that is at any given moment there could be a headline, and to be quite fair, that was very common in the first Trump administration. then the vol market needs to price that in, right? And so if all of a sudden there's going to be a new tariff every 7 days, well, likelihood of volatility coming in completely probably won't happen, right? And the reason for that is because there should be a bid on the wings, especially to the downside, right? And so skew, how it was traditionally more of a contango market, which was more favored to calls over puts, we've seen that come in, right? And we've seen the sellers of the calls really start to step into the market. For the first time in a long time, we're starting to see flattening in 3 month, 6 month, year durations in skew. And so that'll be very interesting to watch heading forward and as we kind of progress through Q1 into this year, right? And so outside of that, there's been positive news and positive developments that have been supportive to the crypto industry. However, the main focus has continued to just be on broader economics and global economics, right? And so tariffs largely on larger markets are showing to have a larger impact, even in a market like crypto that's not largely impacted, right? So that's one thing to note. And that's basically kind of what's been happening. So up until Jan 20, the full focus was on the new Trump administration. And after that, it's been Trump administration has stepped in and just created a lot of disruption to start. And so markets are normalizing now and getting more familiar with this new regime and an understanding of what this means. But to start the month in crypto, Ethereum did see declines in large liquidations in the billions down to almost $2,000. So it is proving to be a very large realized fall environment. So let's jump into the weekly outlook, and then we'll talk about some strategy as well as we kind of progress through this week. And we have a large figure tomorrow, the CPI, which could be another reason to move markets. So what you are seeing here on the left, and for those that are unfamiliar, this is our quantitative and qualitative data. It dates back to, I want to say it's been, 30 years now that it's existed. It's transitioned from the pits back in Chicago and kind of transitioned into digital world as all trading has, right? And so specifically you see Bitcoin on the left, right, the price map, and then you see the Bookmap on the right. And that's going to be where we're going to focus on some of the microstructure and then align it with our expectation for the week on the price map, right? And so what we always talk about when we talk about the price map is the weekly directional, right? And so the weekly directional is that green figure there. The fact that it's green this week means it's a pivotal week. The market could go up a lot or could go down a lot, or it could just digest around the figure. So it's not giving us a lot of color outside of the fact that if it's under the figure, it's negative, and if it's over the figure, it's positive, right? The reason I say that all three outcomes are possible is when a market is balanced, it doesn't need to become unbalanced, right? Unless it's pushed into a state of unbalance, right? And that's thinking about it in terms of volatility, thinking about it in some of these other terms. Volatility doesn't have to go higher, right? And this is an interesting concept, but volatility is great for traders. It's not great for investors traditionally. And just because a market is balanced or volatility is coming in does not mean it needs to go higher, right? It doesn't need to mean revert higher. So the focus this week is specifically on 97,177. That's our weekly directional. If we can't break out of the CR minus to the CR plus, which is 100 down to 94, then the expectation is a fairly tight range, continued trade around what we've done last week, right? Now, if the market starts to break out of these minor levels, right, the brown seen on the left side, which is 94,274 up to 100, then it has the potential to really extend, right? And so 102,860 is a good target for the week to the upside. 91,371 is a good target to the downside. Now, specifically to the downside, let's talk about that. Because the market has been so bullish for the better part of the last year, it does bring into question what a normal range would be to the downside, right? Normally, market stairs up and elevators down. We have seen that first elevator down. If the market really wants to break, it would need to hold a trade under 91,371, but it would need to take out this previous week's low, which you can see right here, which is right around 91,000. And if it were to do that, the move lower would likely be quite fast. And the reason for that, psychologically, anybody that's buying the dip here is just wrong. And there's going to be a lot of fear mongering. There's going to be a lot of news pieces that say Bitcoin's dead. All of this that anybody that's been in crypto for many years now has seen. The reality is that would be a normal digestive move lower, right? And so that target would target the 85,626. And if the market really wanted to extend in a fast way, it would go down to 79,882. However, the current expectation is downside target would be 85,626. A normal range would be defined by your 91,371 up to your 102,860. And your over under number for the week is going to be that 97,177. Let's take a look at some of the resting liquidity in the book, right? And so this is your multi-perp book, right? And so we have some resting liquidity down here at 95,000. It's aligned with this variance level, right? So aligned with this brown area, which would define kind of that tighter range on the week. Specifically, it's just in alignment with the current weekly low, right? To the upside, you have resting liquidity around 97.70, right? Which is, and there's a lot more. Right around 900 coin is sitting there, and 1,000 coin from 97.5 all the way up to 98. Those are basically today's highs. That is showing the inability to break out to the upside. And so markets do like to trade to liquidity. So if that liquidity zone is taken out, it will be important to watch. However, if it's not, there's more reason to be a seller of this market, right? Let's scale out a bit and see if there's anything further in alignment. 101, right, is some further resting liquidity. Excuse me. And that's a little bit over this this weekly CR plus. Again, it would just be a tighter range, right? A normal range for this market. This market's been fairly volatile. It broke in the first 3 days of trade, and now it's kind of just digesting, right? And so it's trying to figure out where it wants to go. And in that process, it is compressing what was a very large range from 105 down to 91, back to 102, and now we are moving within a couple thousand points a day, every other day, and slowly getting tighter and tighter, right? And that's in alignment with the balance of the market, shown with that green level at the weekly directional, right? And so resting liquidity, which is today's highs right around 98, and then 101, and then to the downside, 95 is the first level to take a look at. And then and then there should be concern if the previous week's low can't hold. Let's take a look at Ethereum. Ethereum's a little bit different, and so we'll actually talk about that. Ethereum broke in a large way to start the year, to start the month. So we traded from an open of the month of 3,200 down to 2,000, right? And those were largely on just liquidations. And then the market rebalanced right around that 2,400 level, traded higher, and then has just continued to be weak and tightened up on range, right? And so specifically in Ethereum, the green level up here on the price map is a negative sentiment bias, right? And so if the market were to really scale, it would scale to 3214, but the expectation is it would fail there, which is in alignment with previous week's high of last week, because it is a negative sentiment bias. It is fair to assume more of a fade mentality when approaching the market this week. And so where would that fade be? The weekly UP makes a lot of sense. If the market can't hold the 2879, which is the CR plus, then that would be a problem. And to fade that back into the directional, the fact that the market is under the directional right now is not positive. It really needs to break under the previous week's close, right? Defined here. And let me scroll up a bit on this. Which is basically the low of this move that happened in the last hour. If it can't hold the previous week's close, then there's a good reason to look lower. And where would those levels be? 25, 45, 40. And then the next place to look would be down to the weekly DP, which is 2379.87, right? Now, if the market really wanted to break further, a retest of last week's low would align it with 2046. Again, those were on liquidations. But because of the negative sentiment bias on the week, it would be fair to have a negative bias on this market, right? Let's take a look at Bookmap's liquidity, right? And so we have some resting paper at 2,600, which is in alignment again with that CR minus, right? And that previous week's midpoint, more specifically, right? And then we have some resting paper up at 2,700, which again is today's high. And then more resting paper of size is going to be, let's take a look. $3,000. If we were to trade at 3,000, that would be in alignment with that weekly UP that we just talked about. The expectation there is we would fade, right? And so that's 15,000 contracts on the offer. It'd be a fair assumption that we can hold that price and we'd fade it back. Now, where would those assumptions be proven wrong, right? Because we always like to focus on risk as well. If the market can base over 3214.51 and trades to 3,300, the market then is in a corrective hedge theme back higher, right? And so the assumption there is then the market would trade and potentially could target 37.15.30. First target would be 33.81. However, that is not the expectation because the market has that negative sentiment bias and is still heavy on the offer, right? So that is the outlook for the week. A couple strategies is more or less when to participate in markets, right? And so if you are participating in the market this week, where to do it and why to do it makes the most sense for risk reward, right? Key figures in which we're looking at is 2379.87 and 3047.58, right? That is what we define to be a normal range of trade for this week. And a compression of range after what we saw last week it's totally normal, right? So a trade from 2,600 to 2,700 and not much else, that would be normal as well, right? And so being involved at the extremes, right? So 2,379 or 3,047 will help with clarity as you kind of approach the opportunity and think about risk, right? And so that is the best way to think about these markets, and especially as we head into some headline risk tomorrow, right? Headline being the CPI. If it's favorable, market could find a bid. If it finds a bid, where could it trade, right? It's defined all right here. And where would you want to be involved with? What do you want to risk, right? 3050 basically is that weekly UP up to that 3100. That's fair risk for the reward. 2379 down to basically 2325, 50 points risk for potential couple 100-point return, right? So those are areas to think about being involved. Otherwise, might be best to stay out and not participate. So hope you enjoy the week, and we'll catch you next time.